Since I was a kid, I have always been fascinated with numbers, and specifically compound interest, and how compound interest can turn very small amounts of money into very large sums, hundreds of thousands or even millions of dollars, if you give it enough time to work. And that got me thinking recently, and I was wondering how much time would it actually take to become a millionaire if you invested in nothing but index funds. And I think this is incredibly important right now because so many people are chasing the next big investment fad, be it crypto or active stock trading or making money with stock options or real estate or whatever. And I'm just wondering, is there an easier way? I mean, is it really as simple as putting money into an index fund, and can that turn you into a millionaire? I mean, and honestly, even I myself have found myself chasing returns with stocks like Apple, Facebook, Tesla, Amazon, Google. But when I went back and looked at how my investment accounts had performed versus what would have happened had I just invested in index funds, the result was actually shocking. Now, I realize that index funds are not the sexiest investment option out there, but if you're young enough, time is on your side. And if you don't take a long, hard look at the power of index funds, then you could actually be shortchanging yourself a significant amount of time and money when it comes to how long you need to work before you reach a point where you can actually retire. Now, make sure you stay until the end of today's video because I am going to share with you exactly how much money you could potentially be losing by choosing an active investment strategy versus passively investing in index funds over the course of 30 years or so. Now, in today's video, I'm going to explain to you four main things. I'm going to explain to you what an index fund is, why index funds are so powerful, the three index funds that I would recommend that you take a long, hard look at, and how you can get started investing in index funds in just 10 short minutes. You ready? Let's do this. So let's start out with talking about what an index fund actually is. And I think this is really important to cover because any topic that's going to talk about how to become a millionaire investing in index funds, I think really needs to touch on what an index fund is. And a lot of people don't necessarily understand this, or they're confused by this. And there's so many investment options out there that when we're talking about one mutual fund versus another, a lot of people don't understand. Maybe they think they're investing in an index fund, but they're actually investing in an actively managed fund. And it's important that you understand the difference. When I first started learning about mutual funds back in the early 90s, when I was a teenager, there were so many options out there. And the whole idea was to pick the best money managers who were basically going to manage your money for you. And that's what a mutual fund is. It is people pooling their money together with a fund company, where that fund company is then going to hire an investment portfolio manager who's going to manage that money and invest it in what they think are winning stocks and not invest it in what they think are losing stocks, with the idea being that over time, the return on your money will actually beat the market averages. Now compare that with an index fund where it's a completely passive strategy because all the fund company is doing, they don't need to hire an investment manager for them. They're just merely investing your money into a basket of stocks that is going to mimic the return of the index. And with computers these days and algorithms, it's even easier than ever for a fund company to run an investment vehicle like this. And you see index funds popping up in all the major fund companies now. So the way index funds do this is they invest in the market as a whole, or a subsector of the market, maybe healthcare or pharmaceuticals or manufacturing or something like that. Or they can invest in a market like the S&P 500, which is a basket of the 500 largest stocks in America, or the Dow Jones Industrial Average, or the NASDAQ. There's indexes for all these things. Or you could buy a total stock market index, which invests in all of the stocks that are traded in the United States or in Europe or wherever else you want to invest in an index fund. Now, the very first index fund was started by John Bogle, who was the founder of Vanguard back in 1975. And at the time that he started this index fund, which would ultimately become the Vanguard Index 500 fund, people said he was un-American. They said, this is ridiculous. Nobody wants to invest in something like this. But he was smart and he thought, you know what, people are going to want to invest in this. And over time, by 1999, the Vanguard Index 500 had surpassed $100 billion in assets under management and had surpassed the Magellan Fund as the largest mutual fund in America. Now, index funds are incredibly powerful for a variety of reasons, but there's two primary reasons that I want to talk to you about here today. The first reason they're so powerful is because of the fact that they're actually passively managed. So you don't need to pay a portfolio manager to manage the mutual fund for you. And because you don't have to pay a portfolio manager to manage the fund, the management fees for the fund are going to be significantly less than they would be for an actively managed fund. So a typical index fund will have an expense ratio of somewhere in the name of 0.01% to 0.04% versus an actively managed fund that could have an expense ratio of 0.5% to 2.0%. Somewhere in that range. So I want you to think of it this way. When you purchase an actively managed fund, not only are you taking the risk that that portfolio manager is not going to actually beat the index that you're trying to match, but you're also taking a risk that you're paying more in fees. So not only does the portfolio manager have to beat that index by at least the amount of their management fee. So if you earned 10% with an index fund with almost nothing in terms of an expense ratio, that portfolio manager would have to do at least 12% to break even on the index because of the management fees imposed. So that's the first major risk you're taking by investing with an active fund manager. So not only are you taking a gamble that they're not going to actually beat the index, but you're also taking a gamble that they're not going to beat the index by enough to recoup the management fee. And the second major reason why I love index funds is because they are tax efficient. And what do I mean by this? Well, when you are taking a traditional index fund, the annual turnover for that fund is going to be somewhere between 4 and 8%. And typically, this turnover is because stocks either come into the index or they leave the index, and the index fund has to reallocate to make sure it's matching the stocks that are actually in the index. When you're talking about an investment manager, however, who is actively managing a portfolio of stocks, there could be anywhere from 30 to 50% in turnover each year, and that's because they're buying and selling stocks, and not only is there turnover, but they're actually incurring capital gains, both short-term and long-term capital gains every single year that ultimately you're going to have to pay taxes on if you're not invested in a tax-protected vehicle. So if the money is not in a Roth IRA or a traditional IRA or a 401k, then if it's in a regular investment account, a taxable investment account, you're going to have to pay taxes on those capital gains every year versus an index fund where the turnover is very small, and so you are not going to have to pay as much in taxes on that turnover each year. So when we're talking about investing in an index fund, you really have several options at your disposal. You can choose to invest in like an S&P 500 fund, you can choose to invest in a technology fund, or you could do what I like to do, and that is invest in the total stock market as a whole. And by doing this, you're capturing all the stocks in the stock market, both the large cap stocks, the mid cap stocks, and the small cap stocks. And so versus just investing in, let's say, the S&P 500. And so there are three main vehicles that I use to invest in the total stock market. And it really comes down to, at the end of the day, which brokerage house do you want to go with? And the main ones that I look at are Vanguard, Schwab, and Fidelity. I will be honest, most of my investments are actually at Fidelity. I do have a small amount at Schwab, and I do have a small amount at Vanguard. And regardless of which brokerage house you decide to go with, all of them these days have some sort of index fund that you are going to be able to invest in. So if you decide to go with Fidelity, where most of my money is at, a lot of thunder going on outside. Wow, did you hear that? So if you decide to go with Fidelity, over the last 5 years, the 5-year return at Fidelity has been 17.36%. The expense ratio for the Fidelity Total Market Index Fund, which the ticker symbol is FSKAX, is 0.015%. And there is no minimum investment to invest in this index fund. If you decide that you would like to go with Schwab, they have the Schwab Total Stock Market Index Fund, SWTSX, which has a 5-year return of 17.82%, an expense ratio of 0.03%. Again, no minimum investment. Now, Vanguard is where I used to hold a lot of my money, and I really like Vanguard because, like I said, they are the company that really started index fund investing. But what I found is a lot of their funds require a $1,000 to $3,000 minimum. And with the Vanguard Total Stock Market Index, it's the same thing here. There is actually a $3,000 minimum investment. So if you're just getting started and you don't have any money to invest, and maybe you want to start with $50 or $100 a month into an investment account, Vanguard might not be the best choice. But to compare to the other index funds, the 5-year return for the Vanguard Total Stock Market Index Fund, which is VTSAX, is 17.39% per year. The expense ratio is a little bit higher than the other two at 0.04%. And like I said, the minimum investment for that fund is $3,000. Now, sometimes mutual funds will waive that minimum if you do set up an automatic recurring investment. I couldn't find anything with that with Vanguard, but that is a possibility. Frankly, I would probably go with the Schwab or Fidelity if I were just starting out and had no money and was just starting with a $50 or $100 a month deposit to the account, which is how I started way back when I was in college. So let's talk quickly about how you can get started opening an investment account and investing in one of these funds. It's as simple as literally going online, finding a little button at Vanguard or Schwab or Fidelity that says open an account, and you can have an account open in as little as 10 minutes online, and then you can auto transfer money from your checking or savings account into that account. And then once the money hits your account, then you're going to go ahead and just purchase the mutual fund that you would like to purchase. It's actually that simple. Now, at the beginning of today's video, I promised you that I would explain how you could lose a significant amount of money if you invested in an actively traded mutual fund versus a passive index fund. Let's assume, for the sake of argument, that you have two separate funds that you could invest in, and they're both, one is actively managed, one is an index fund. They're both large cap mutual funds, and the index fund is set to track the market, the actively managed fund is set to try and beat the market. If you started with $100,000, you earned a 7% annual rate of return for each fund. Let's say, for example, that they both match the market over the course of the next 10 years or so. Remembering the actively managed fund, you have to spend around 2% per year in management fees. All right, so when I initially created this video, I used a 2% expense ratio as the average fee for an actively managed mutual fund. And that is actually incorrect. So I did a little bit more research here as I was editing this video. And actually, the actual fee is about 1%. Now still, that doesn't sound like a lot. So 1%, if you invest $1,000, 1%, that's $10 a year, I think, if that's right. Yes, that's $10 a year. So a lot of you might be thinking, well, that doesn't sound like a whole lot in terms of fees. What's the big deal? Well, the big deal is, let's say you had a choice of two mutual funds. The first mutual fund would just track the market, and you know it's going to track the market because that's what it's invested to do. And the fee is virtually nothing. And so you've got that mutual fund, and then you've got another mutual fund that is an actively managed fund. And let's say the management fees are 1% a year. And let's say they do exactly the same. Let's say the actively managed fee fund actually tracks the market, but you're paying 1% in fees. The index fund tracks the market, but you're paying basically zero in fees. Here's the difference. At the end of 10 years, you would have $17,630. That's how much you would have spent in fees to the actively managed fund. Versus and this is assuming that you get a market return of about 7% per year, which historically has been pretty average for the stock market. Over the course of 30 years, however, the fees that you would pay to the actively managed fund are $186,876. And if you go out 40 years, you're talking $468,873 that you would pay in fees to an actively managed fund that you couldn't even guarantee would actually beat the market in any given year. For that reason, I believe that it's much better to go with an index fund. So if you're sitting there thinking that these fees don't matter, they're not that much, think again. They can cost you a significant amount of money over the lifetime of your investments with that fund. I don't know about you, but personally, I don't want to pay that much in fees, and I'd be much happier getting a market return with no fees than gambling that I may or may not get a market return and pay $330,000 in fees over the lifetime of my investment. And this is why so many people in the FIRE community are so enamored with the use of index funds, because they know how powerful they are, they know that they're tax efficient, and they know that they're not going to pay a lot in fees, but they're going to get a market rate of return on their investment. Honestly, what's not to like? Now, if you're sitting here and you're thinking, Jim, this is all great, but I can beat the market, and so I don't need to worry about the cost of those fees because I'd much rather hire a fund manager that's going to beat the market. Or alternatively, I personally can beat the market with my investment returns. Over a period of 15 years, I found an article in businessinsider.com. According to a report they did over a 15-year period, nearly 90% of actively managed mutual funds failed to beat the market. Something to think about. There you go.